Hi, everybody. Welcome to the Sherman Show. I am Jeff Sherman, along with my co-host, Sam Lau.
Hey, hey.
And he's back. I know you missed him the last time. Sam was on sabbatical. He thought he was retired. But just like in The Godfather, we brought him back in. He thought he
Just
was
when I
getting
thought I
old.
was out, they bring me back in.
Absolutely. So welcome back, Sam. And the reason we got Sam back today is we have a very special guest here on Monday, November 20th, 2023. We have the CEO and CIO from Damp Spring, a full-service macroeconomic research firm headed by Andy Constan. And we have none other than with us today, Andy Constan. So, Andy, welcome to the Sherman Show.
Thanks, Jeff. Thanks, Sam.
Yeah, so it must be a slow week over at Damp Spring if you're joining us on the webcast today. But, I'd like to really start off by introducing people a bit to your background. You've had a lot of roles as an idea generator. You were a chief strategist at some prominent names too. So maybe you can walk us through a little bit about your career and what got you to ultimately launch Damp Spring.
Sure. So I started my career in 1986 at Salomon Brothers, which was a large investment bank at the time, well, famous for its prowess in trading bonds, but we were full service. And I became a trader after the Brady Commission that examined the stock market crash, where I got to serve as Salomon's representative and fell in love with markets and moved down to the trading floor in 1988 and traded equity derivatives, convertible bonds, pretty much every product except mortgages throughout my trading career. When I left, I was the global head of equity derivatives, sales, trading, research, everything. And I started my own hedge fund that was okay for a few years, and then partners sort of clashed and we closed it all down. And I was on the sidelines during the financial crisis and thought had retired, but they pulled me back in. And I decided that what I really needed to understand is macro investing. And so I joined Bridgewater Associates, which I think is the premier thinker in macro, systematic macro in particular, but also just brilliant minds in thinking about macro, and worked for them for a little over 3 years. The culture was a challenge, and I decided finally to moved on to work at a discretionary macro hedge fund of long-term standing and great reputation called Brevan Howard. There I worked with Alan Howard to build some systematic macro that they were trying to put into their discretionary firm, and then also became chief strategist and provided all of the traders at Brevan my framework for understanding the economy and linking that to what's priced in and then what to do about it in markets. And by 2019, Brevan had unfortunately lost a lot of assets under management, and they decided to spin me off into a research firm. And that's what launched Damp Spring. And my initial client was Brevan Howard. And then I picked up a number of institutional clients, hedge funds that I consult on that framework and that strategy. And then I started writing on Twitter, and started with 100 followers, friends and family, but started interacting with a bunch of the FinTwit people out there and got a following. And now I'm got about 120,000 followers, and I'm read by, I guess, a lot of people, and that's really both expanded my hedge fund business and allowed me to help individuals as well.
Yeah, I was going to ask you to introduce our audience to your macroeconomic framework, but it sounds like that may be a little bit of a conflict here, given that you charge a lot of folks for that insight. So maybe we could just back up a little bit and talk about some of this too as you think about the world. What do you think kind of key variables are to focus on when creating one's macroeconomic framework?
Yeah, so I'll be happy to share my macroeconomic framework. I think it's general enough that everyone should be able to understand it, but also not going to cost me business, I don't think. When I think about macro, there are two things that I think are pretty much table stakes nowadays. And that is, you have to really have an outlook and understanding of how growth occurs in an economy, and how lately, in particular lately, how inflation works in an economy. Many people in in markets have forgotten what inflation has been like. And so, that's having that understanding is critical in the last 3 to 4 years. And that's table stakes. I think everyone has to have a good understanding of how those two things work and what they do to asset prices. The things that I've added are really understanding the risk premium that assets contain, and how policymakers and how market participants can influence the risk premium, which is the return you get on assets. So that has been, where I think I've made my mark with clients and on the web and through my research. And then lastly, I think understanding positioning in a deep way, to understand that, when those three other things are moving, it still matters how people are positioned, what's priced into markets, and what's going to cause investors to change their positioning. And so that's the 4-pillar framework I operate with.
So without, again, giving away the keys to the kingdom here, as I think about risk premium, how do you create a framework around that? Again, being somewhat obtuse here, not getting into all the weeds, but we always hear about there's an equity risk premium or there's a credit risk premium, and a lot of it points to historical data. But I think sometimes what's missed in that, and again, correct me if I'm thinking about it incorrectly, but there is a point where valuation impacts that, right? And so a lot of people use history as a guide, but you have to think about it on a forward-looking basis too. And so how do you kind of think about those things together when creating a framework for thinking about risk premium?
Right. So, a lot of people want to pin down risk premium, equity risk premium, bond term premium, any premium that an asset contains, into a specific thing that should be correct. And that's like saying that a PE should be correct. No, it shouldn't. There's no level that is the correct level. And you should, if term premium is too high, you should buy assets. And if it's too low, you should sell assets. I think you'll get yourself in a lot of trouble, just as most investors get themselves in a lot of trouble when they think about, what the fair value of an investment is. And if it's less than fair value, they buy it. And if it's greater than fair value, they sell it. Markets overshoot all the time to those levels. And it's very difficult to be an investor to just base your investment thesis on the level of valuation. And so the level of risk premium is not that important to me, because for one, nobody knows what it is. So the only way you can interpret risk premium is through a model. All models have assumptions. All models require assumptions of forward-looking information, which is unavailable. And so it doesn't exist. Term premium is just a concept, not a thing you can point to and say, yes, the term premium is this. And so my framework just focuses on what could change term premiums, because that's what you need to know to be an investor. If you think term premiums are going to fall, you want to own assets. If you think term premiums are going to expand, you want to sell assets. And so my framework just focuses on the factors that would cause term premium to change.
So do you think about that from you're using the cross-section of these variables to think about those dynamics? Is it using some form of momentum and thinking about monetary flows? We all know that flows drive asset prices both directions, right? Is it trying to capture some of that? Or is it really comparing things somewhat cross-sectionally and thinking about how those macroeconomic drivers influence those things?
Right. So there's a couple of things you're saying there. The cross-section issue potentially has to do with the way various assets are priced and what their term premium might be. And then there's the aggregate class of assets and how those term premiums evolve. Let me step back and describe what I mean. When I talk about a factor that is going to influence term premium, I've really broken it into two things. One is if the investment world, all assets that are available for investors to buy and sell becomes riskier for whatever reason. Just if you hold assets, you're going to experience more P&L risk every day. You'd prefer cash versus, and so your natural view is, hey, I thought assets had a certain expected return and a certain risk, and the expected return hasn't changed, but the risk has gone up. I want less assets. And so that's a sort of factor that should cause risk premiums to expand as people who accept the assets you sell are also looking at those factors, and they're going to charge you additional risk premium in order to take assets off your hands. And so portfolio volatility is a very important concept in terms of term premium drivers, and portfolio volatility has to do with individual asset volatility, has to do with correlations between assets. And so having an understanding of what drives volatility and what drives correlation is an important aspect of portfolio volatility targeting or expectations. The other factor for term premium is if you think about all assets that could exist, and you think about all the money and credit that is around and available to buy those assets, you can think of those as a supply and demand. And when more assets are creating supply of assets for the same fixed amount of money and credit that's available to buy them, meaning money is getting tighter, you would expect term premiums to expand. On the other hand, if the Fed is buying assets through quantitative easing, for instance, or lowering the price of money and credit so people are more willing to borrow to buy assets, those factors can cause term premiums to collapse or contract. And so that's the framework. The supply and demand of money and credit versus assets, and the volatility of a portfolio of assets. And so my work just says, how are those things changing?
Yeah, no, I mean, it's great. And again, I think it's important as you think about this to step back and, like you said, it's still a model, right? We all know that it's just a model. It's inputs. There's estimation error, and it's whether or not it gets amplified through one's model. But you mentioned at the onset that perhaps people have not been thinking about the inflation component for let's call it over a decade, right? Where we had this compressed inflationary regime. What is your thought? What are your thoughts about inflation today? What are your thoughts about how investors should incorporate some of this into estimating some of these premiums, and hence thinking through the allocation process? So what's important about inflation today?
Well, I think the first thing is obviously it is coming down and has been coming down for a long time. After a supply spike and then a monetary and fiscal stimulus, allowing people without the ability to work to still consume, and then a reopening, which allowed people which caused a with the sizable demand, required a lot of people to be hired, and there were a limited number, and so prices rose. Supply chains corrected, inflation came down, monetary policy began to become less easy, and inflation began to fall. And that's where we are. And it looks like, if you extrapolate the data, it looks like not only are we going to reach target relatively soon, but we may undershoot. And so inflation may be dead. Now, that's not my view. My view is the problem is much bigger, and the factors that drive that, the potential for increased growth and increased inflation, or at least a plateauing of both of those things at a level that is well higher than the Fed's desired targets, are those, a number of factors are in place. And so those factors are a still very strong job market, which has weakened a little bit, but shows very little sign of weakening to target that would be sufficient to kill inflation. The residual ample reserves that still are coursing through the system, that will keep liquidity still high and support demand, which needs to be withdrawn through quantitative tightening, which is taking time. And then there's it's a cyclical change from globalization to de-globalization. And globalization was a decades-long secular trend, resulting in lower prices for the world as people with low productivity were moved from the farms, the dirt farms, subsistence farms in central China to the cities, and became significantly more productive at a much cheaper price. And that happened in many regions of the world. And so COVID has changed that secular trend, and I'm not sure it's cyclical yet, but it is secular yet, but it's certainly cyclical, which is this nationalistic de-globalization, in which, and I describe it as 3Ds. One, we create duplicate supply chains using our own neighbors who are allies and closer. And two is creating domestic energy infrastructure, which all of the various nations are attempting to do with whatever particular form of energy generation they have, but the investments are sizable. And then there's true deglobalization, which is called onshoring, in which we decide that it's a national priority to have chips manufactured on our shores. And those three things are they're pitched to us as not inflationary, even though they require significant upfront spending. But that's because they are pitched to us as replacing other providers, and so we're going to make our stuff and it's going to be cheaper. But the fact is, we'll have a significant amount of capacity and waste that is created when you have duplicate supply chains. There's no efficiencies that are created from that. And so the deflationary payoff is not clear to me that it'll come down the pike in a number of years, but at the moment, it's very inflationary. And so those three factors of money in the system, jobs, and the 3Ds of deglobalization are likely to keep inflation higher for longer.
So you point out that this could be something secular. In speaking with some folks, what I've heard as of late is it's nice with this disinflationary environment. Words we talk about, like when we speak macroeconomics, but it just means a decelerating rate of inflation from previous levels we had. But what do you think about the impacts, like on a cyclical basis, from the cumulative inflation that we've experienced, right? And so you hear this from, kind of lower income cohorts, folks that, don't have the savings, don't have assets out there, that how much more expensive things are. and potentially things haven't kept up. So do you think that that has an impact on that kind of, let's call it the short to medium term cyclical component, that this cumulative effects of inflation, we haven't really seen all of those effects yet, which may scare people into thinking it's deflationary or back to this other environment, but still the underlying forces you just described are still at play. So how do you think about the interplay there? Or do you think that that's that kind of cyclical thing that I'm talking about, cumulative inflation, won't necessarily play out?
Yeah, so, what I think markets care about and policymakers care about is the forward-looking inflation. I think sociologists and politicians should care about the impact on the various cohorts that are experiencing inflation and how they may behave both politically and socially. It's not a great thing not a great thing at all, that we're finding that there are winners and losers in this game, and the losers are losing pretty heavily. And to kill inflation, it's most likely that they're going to lose. Some of them are going to also lose their jobs. And so it's a pretty ugly circumstance politically and socially to have that cumulative inflation. But I think policymakers have to think about forward-looking inflation and whether they can control it or not. And, I think the markets are pricing the Fed beginning to cut rates. We're going to land softly, and inflation is going to, despite all these upward pressures on inflation that I've described, we're going to experience inflation back to target without anybody really losing their job. And I think that's where markets seem to be priced. And I think that's a possibility. It just seems extremely low odds.
I mean, it almost feels like a little bit of complacency from the market, participants at this level. But given some of your thoughts around this about inflation and perhaps how it might translate into the real economy, what are your thoughts here in terms of Fed monetary policy response moving forward? Because it just seems like, really, since the November meeting, and really what preceded that was, I guess, the quarterly refunding announcements leading into Jerome Powell's presser. And then from there, it just seems like markets have just started to rally on this idea of perhaps a dovish pivot. But to me, it seems like a little bit early for that.
And that comes back to my principal framework that has been the dominant impact on my research for a while now, which is the impact of issuance and quantitative tightening on financial conditions. And, when we saw quantitative tightening announced well before it, which was in December of 2021, I called it kryptonite for assets and a game changer, and said the market was yields were going to rise significantly and equity prices were going to fall. I think I said 4,400 at the time, which turned out to be very optimistic. And the reason is that is a tightening of financial conditions. And so the tightening of financial conditions causes risk premiums to expand, which causes assets to become correlated, which causes risks to be higher because there's no diversification benefit. And you get what happened in 2022. And so I think that really was the major thing. And then, come the end of 2022, markets closed weak for the year, but then started to take off substantially. Now, some of that was AI hype, which has turned out to be AI reality in many ways. But the rest of it was a broad tightening contraction in term premium. And I believe the reason is you have to understand the mechanism of quantitative tightening. Quantitative easing was simple. The Fed bought bonds. Quantitative tightening is different because the Fed is just letting their bonds mature. And Janet Yellen, the Secretary of the Treasury, decides how to pay the Fed back with what she chooses to issue. And in the first half of this year, she had very significant limitations on the national debt because of the debt ceiling. And so for 6 months, she was essentially limited in what she could issue. And so because there was lack of supply, QT essentially got muted during that period of time, and assets were able to do well enough, in fact, so that, what appeared to be a pretty big disaster in the regional banks turned out to be a non-event. Now, there was some policymaker response that also eased things, but by and large, we got through a pretty difficult event with no big deal. Now, in July or June, the debt ceiling came off, and Janet decided to raise money to get the deficit funded and to rebuild her bank account and to pay off the Fed by using Treasury bills. She used close to $1 trillion in Treasury bills in the third quarter, and very little coupon bonds, which meant that there was a huge demand for Treasury bills, and assets just could see no headwinds of large supply. And that all changed at the peak of the market on July 31st, when Janet Yellen said, we're going to increase the amount of bonds from 178 billion to 338 billion in Q4. And front running of that supply happened in earnest. 30-year bonds, 10-year bonds sold off by 100 basis points, from 4 to 5% in just 3 months. The equity market fell 10% in just 3 months. Now, both markets went down. So this was not growth. Inflation was, trending down like it has. This wasn't growth. This wasn't earnings. This was just term premium expansion ahead of a large supply. Essentially, QT became unmuted. And then on 10/31, Janet decided to mute it again and not increase the bond supply anywhere near what was expected by market participants. And what you've had is what you should expect when, as I said, the big thing is there's this money and credit that's available to buy assets, and then there are these assets which, if their T-bills are not very risky, but if their coupon bonds are quite risky, and there's limited capacity to own those things, so people need an incentive to buy them. And so what's happened now that supply didn't come to market? Assets have rallied massively. The NASDAQ is higher than it was on July 31st. The S&P is within whiskers of where it was on July 31st. T-bond 10-year note yields have rallied 50 basis points, almost 60 now. And that is in 18 days. And it only, it's pretty straightforward what happened. Powell didn't say that much in the presser that would cause, every asset on the planet to moon, the dollar to sell off. We just had a massive financial conditions easing that was created by the Treasury's decision to not sell as many bonds as markets expected, knowing full well that what they were doing was not selling as many bonds as market expected. And so in my view, that's been the cause of this very significant rally in all assets.
But Andy, isn't that antithetical to what the Fed is saying to us at the pressers, right? So you said Jay did nothing, or Mr. Powell did nothing to do this, but isn't it antithetical to what they're talking about and being inflation fighters and watch this? And there was a direct question at the press conference, right, about, monitoring financial conditions and the bond market's doing your job for you by tightening. And so aren't these things kind of at odds with one another?
Yeah. All October, every Fed official, Waller, Logan, Williams, Kashkari, even some of the doves said higher yields, higher long-term bond yields are doing some of the Fed's job for them. And thus, this is the important part, and thus we may not have to raise rates as much. Well, that's all out the window. That is
right. And so how does that square with the higher for longer rhetoric? See, that's the whole thing. I agree with you. And it felt like that getting near that 5%, increase in the term premium, as we wonky folks call that, right, across the market, it seemed like it was trying to do its job. And I thought at that point it would lead the Fed to just stay higher for longer with no need to do anything. Do you think that dynamic changes here and we get more volatility in the term premium because of this?
Well, here's what I think. I think we had between a 25 and 50 base on the QRA day. Janet cut interest rates 25 to 50 basis points. That's what she did. Now, she doesn't run monetary policy, but she cut interest rates. And cutting interest rates will have the effect it has, which will stimulate demand. At the same time, the Fed is doing everything it can to keep demand under control. Now, the thing is that the data that we've seen since the QRA has been cold. And that's because it came from a period of time when 30-year bond yields were 5%. So there's going to be a lag in which it appears that this easing of financial conditions is not happening and not causing inflation and growth to be stimulated. And so there might be a period of time in which the Fed does nothing and just sort of lets the data play. I think what will happen is assets will continue to assume that we're heading toward a soft landing and rally both bonds and stocks until so on January 31st, Janet's coming again, and she's coming with a ton more bonds because she has a ton more bonds to sell. And so I don't know between now and January 31st what happens, but on January 31st, assets are dead. Unless she decides again not to come with more bonds and just ramps the bills even higher and takes the monetary policy lever away from the Fed, and the Fed just sits by and lets it happen. But they are at odds.
Well, today we had the best 20-year auction. We had the best 20-year auction we've had really since the creation of the 20-year, the reintroduction of it too.
The 20, I watched all the auctions. The 20 is just they call it a redheaded stepchild that doesn't get any love. But this time it did. We had a 30-year auction that was awful.
Yeah, the certain yield, I guess, above, its neighbors at the 10 and the 30-year mark. I guess it does draw a crowd there. But can you draw the distinction with regards to Treasury refunding or quarterly refunding and this idea of Janet selling less than expected? That's one component. But then also you started you mentioned it, the difference in selling between the coupons and the bills and how that plays out in terms of fiscal / monetary policy. I guess they're all one and the same pretty much in this conversation.
Yeah, so I just like to think of it this way. The government needs $1 of financing, and it can finance it in many different ways. And if it were to finance it entirely with bills, those are very low risk. And so market participants can, with a very small incentive, find a way to lever up and buy bills. Just extremely high because there's very little risk. They get their money back in a week, a month, 8 weeks, 12 weeks, etc. If the government decides to finance that dollar with a 30-year bond, well, that has quite a bit of price risk, and people would want a high return term premium to assume that risk, and there's a limited set of investors who would even consider it. And so the choice on that spectrum, and it is a spectrum, they use bills, 2 years, 3 years, 5 years, 7 years, etc., tips, floating rate notes, all the various securities they offer. Each has a certain risk, and if you demand less risk from the market finds ways to take risk that it wasn't able to get from the Treasury. And that's what we're seeing right now is the market scrambling to own risk because they expected to be able to buy some of their risk from the Treasury.
So as you think about this too, I mean, it's completely logical how you've laid all this out. But the market narrative was that it's not some term premium coming back in, or it's this habit. It's that there's this long-term structural deficit, and ultimately the deficit will matter. And ultimately, a deficit does matter at some point in time. It matters when it matters, of course, right? When the market wakes up to it. But how are you thinking about this as you talk about Janet's need to finance things, and she'll pass it on to the next Treasury Secretary as well. But does it matter in your framework? Is it a relative kind of game? I mean, we've seen Japan do it for many decades. And so the question is when does it matter? Obviously, it becomes untenable when debt service consumes so much of the deficit. But is that really a problem that investors should be thinking about today? Or is it something that we need to have in a longer term framework?
Yeah, so I think the important element, so that's an interesting discussion. Topics like MMT come up in that discussion, and let's head on to that in a moment. But I think the important distinction I want to make for this particular environment is that it's not the deficit that matters. It's quantitative tightening and paying back the Fed, who withdraws liquidity through the reserve balances of banks and the money market fund RRP. That withdrawal of $720 billion a year needs to be financed, and so that's really my focus, because it's quantitative tightening, and the goal of it is to widen risk premiums to hit the wealth effect, to slow the economy. The bigger topic we run a deficit. We are going to have a forget paying back the Fed there, $720 billion. We're still going to need $1.6 trillion from the market just to finance our spending in excess of our tax receipts, which is our deficit. Now, that's a super complicated issue, because when the government spends, it hands money to the private sector. It literally deposits money into the private sector's bank accounts, whether it's a defense contractor or a Social Security recipient or a doctor receiving healthcare from someone's healthcare benefits, Medicare, whether it's interest, which flows into savings accounts. All of that spending is deposits in people's bank accounts. But the great thing about it is turns ultimately, as it flows through the economy, through consumption, income, savings, it becomes savings. And the only thing available to save are the government bonds. And so our spending is handed to the the private sector, and the private sector uses that money over time to buy the same bonds that we use to issue that deficit. And so there's a period of time in which, those flows, it matters, are we issuing a lot of bonds today and not spending until 6 months from now? Well, that's a timing issue. But in aggregate, every single day, some of our spending is converted into savings to buy the bonds that we're issuing on that day. And so MMT people would say you can increase your debt without limit. And most people, for whether it's a psychological problem that we all think of our debt, personal debt, our private sector debt, our corporate debt, as something that has a limit to how much debt we can go into, but we don't own a printing press. And so it really depends on and Japan is a good example. They rose, their debt to GDP is over 200%, might be over 300%. It's high. Ours is not that high. And even if the interest rate is high, we still get to print it. So, I'm fairly agnostic on whether there is a limit, but I'm meaning I don't want to take sides on the MMT versus traditional understanding of the way the world works. But I would say that we are doing MMT We are creating a deficit in a period of time of strong growth, which is very unusual. So we are doing that spending, which is very stimulative to the economy. And we're way away from a point where it's going to reach any, if there is a capacity, we're nowhere near it.
Yeah, it's, kind of drawing on everything we've been talking about for the last, I guess, almost 45 minutes here, just putting it all together. Not necessarily just from a portfolio construction point of view, but in terms of, the way that market participants are thinking about the next, I'll call it 6, 12 months, maybe even longer. But what are some of the underappreciated risks, I guess, out there that people might be missing or just being a little bit too complacent about? And then, if you're more optimistic, what are some of the appreciated opportunities that people might be missing as well?
I think so I'm at the moment, if you talk to me on the 31st, when I saw that Janet wasn't going to issue bonds, I said on television, actually on CNBC, buy all assets, because term premiums were going to collapse. And that's exactly what's happened. Now it's only been 18 days and, stocks are up 11-12%, and that's more than I expected. And so I'm actually now in the position of saying, as a raise some cash, if you were all fully invested on the 31st, on my words, raise some cash. It's probably a good idea. And I would think that, this term premium expansion is going to run into either the Fed pushing back by tightening monetary policy. They could even change quantitative tightening, though I think that would be very unlikely in terms of how much they do more. But they could hike interest rates. They could jawbone the fact that they no longer have these higher yields. That may not have much of an effect. But on January 31st, we get to see another piece of data. And so my basic view is we're in a point where assets have significantly richened and are probably not going to perform as well as cash as a group. Stocks could go up, bonds could go up, but both of them aren't going to go up in excess of cash. And so I'm raising cash or getting short in my alpha account. And on January 31st, I'll know which way I want to go.
Yeah, I mean, I think as I think through it too, it is pretty amazing when you look at just the last few weeks, your 18 days, as you say, it has been lower quality, right? I hear it from our credit folks too. It's the triple C's, it's the lower cohorts that were struggling with higher yields and tighter financial conditions. And so it's almost like a prescriptive playbook there, where, you see it, whether it's small caps, you see, again, lower quality names, it's been doing that. So Andy, it's been a pleasure to have you on here. We're going to have to bring you back because we didn't even touch the surface here. Maybe it's post new QRA. We bring you back again, and see what the insight is there. But for our listeners out there, perhaps before we let you go, you could tell them how they can get in touch with you, how they can follow you, how they can find more about your work, and again, just be able to grant some of your wisdom to them.
Thanks. So the best way to follow me is at Damp Spring on Twitter or at dampedspring.com.
Yeah. Okay. I've always learned about the oscillating spring, so it's great to see the damp spring, too. I mean, yes, the damp spring is an oscillation, but that's always one of those examples in differential equations that you get. So
absolutely.
So I appreciate the witty Twitter handle. Unlike us, who have Sherman Show Pod, not very creative out there, but it gets the point across. So Andy, it was a pleasure having you today. But before we let you go, we have to introduce you to Sam's favorite part of the show. So Sam?
All right, Andy, and that favorite part of the show is called Sherman Says. It's where I will offer a series of alternating prompts between you and Sherman to get a top of mind response. To pave the way here, I'm going to give the first prompt to Sherman, and that prompt is market overshoot.
Like clockwork, right? It goes both directions. It's a symmetric thing at times, but look, I think some of it is, that I think there's still a cross-sectional economic volatility Like it's not any one data set or any data point through the time series is being volatile. I think there's something for everyone in this market right now. And I think that's leading to some of these behaviors. But never forget the money. The money flow drives everything. And I think Andy's spot on with a lot of this perception of financial conditions as well.
All right, over to you, Andy, with Treasury refunding announcement.
It's important. My old boss at Bridgewater called it right after the 731 QRA, the most important piece of data of the year nowadays.
Indeed, it's interesting. I mean, we've always followed it, but just in terms of how much media attention it's been picking up around the QRA has just been it's been pretty interesting to see that people are gathering on the same concept here.
Yeah, I think it's
Sherman,
the same thing that people used to think about the credit impulses, right? Like how credit expands, how credit changes, and again, it's still implied from financial conditions, but I think they're very much linked. Yeah.
Yeah. All right, Sherman, back to you with let's see here, Fed pivot.
Good luck. And I wouldn't hold my breath waiting for it. As Andy laid out the case, why they really shouldn't pivot at this point. And so I don't see it. I think it's interesting that the market's pulled forward the expectations. But I've always said it's a probability weighting machine. Just because you see this nice smooth glide point, it's just people making bets on things. And so I wouldn't expect the Fed to pivot anytime soon.
All right, back to you, Andy, with earnings growth.
Earnings growth is extremely large in both in terms of expectations, 12% annualized growth for this year, for 2024 and 2025. And if you break that down a little bit, it's still 8 to 10% growth for the S&P 493, which is still a very big number. And very possible, if and only if nominal GDP is very high, which means inflation is very high. So if we get the growth that's analysts predict, that, by the way, they're told to predict by their companies, if we get that growth, inflation is going to be high and bonds are going to be much, much higher in yield.
Which tightens conditions, which has a feedback mechanism, right? And that's why I was talking to some clients the other day, and it was like, okay, so paint the picture. Let's just say you're a company. How do you get to 10% growth? Well, you raise prices 10%, you increase your top line 10%. That can't be great for the consumer. Or you do the other side and you increase efficiencies, cut costs. I think that has to reek of labor reduction too, which isn't great either. So it's tough for me at this point in the cycle to see how we get there, but it's completely plausible, as you said, and never discount plausible versus the probability, right?
Yep. And times like these don't necessarily stick your neck out against a company line, right? When you're being told. So anyway, let's go. I forgot whose turn it is. Sherman, it's your turn. Bank deposit rates.
Complete ripoff. Become financially literate. I was scouring this the other day because someone told me my data was bad. Look at the large banks. They literally offer you 1 basis point on their websites. And so, I mean, the average rate is like 60 or 70, which is probably skewed. There are places that pay you at least T-bill minus fees. And so look for those. Again, they're just a complete ripoff. And so, unfortunately, it's not the U.S. that has financial literacy issues. It's globally, right? We don't teach it. People aren't aware of it. We sit around and debate interest rates and all this all day long. And unfortunately, our fellow citizens just don't have that luxury. So it's your job, Andy, to get out there and tell people that, we can go there. Janet will sell you bills all day long on treasurydirect.gov. Not great for our business, but you know what? At the end of the day, it's the right thing to do.
All right, back to you, Andy, with de-globalization.
Yeah, it's a trend. I don't see it turning. I think it is becoming secular, and it's, the outcome of
populist policy and populist rhetoric from both sides of the aisle in the U.S. and Argentina, today, and it's gonna put up walls and create inefficiencies and make inflation stickier.
All right, Sherman, health of the consumer.
I think it's very bifurcated. We talked about it earlier, right? I alluded to it, right? You have the asset owners that have the wealth effects, the people that have higher incomes and higher asset bases that have done quite well. And you're starting to see some of the challenges in that lower income strata, right? Which you typically see, right? That's part of usually a slowing part of the cycle. But does it spill over? It doesn't spill over unless we have a problem with the labor market. And so, as always, as labor goes, the economy goes. And so, I think it's a very, I call it bifurcated, but when you look at it, it's probably the lower 15 to 20% that are struggling the most. That's why I was asking Andy the question about cumulative effects of inflation, because obviously it impacts that cohort the most.
All right. Let's see here, Andy, for you, U.S. recession.
U.S. recession?
Yes, sir.
I am, with these sort of financial conditions, it's not going to happen.
All right. Sherman, let's wind it down here with the final one for each of you. Different ones, but Sherman, yours is going to be turkey substitutes.
Anything but. I mean, you know my feelings about turkey, Sam. It's I feel like it's one of the worst meat dishes out there. I think it's notoriously dry. Send all the hate mail, all you turkey lovers, send it to me. You got to spice it. Oh, you don't cook it right. It's just a bland. It's the worst poultry there is. I mean, even a piece of rubbery chicken that we get at conferences is better than turkey. In all scenarios, that's why they created gravy to put on top of it, because it's that bad. So this is my least favorite consumption. I don't like the cranberries. I just don't like the meal at Thanksgiving. So again, it's not my favorite feasting day of the year. So I'm happy to let everyone else eat it and overeat that day. So yeah. So what's the substitute? Anything.
Yeah. Bringing up turkey around Thanksgiving almost is the same level of vitriol from you as bringing up vests, I guess, out there as well. So
it's a year-round hate. It's like you playing, Christmas music on the trading desk in like September. That's why we have to establish rules. You can haze me around, my feelings on turkey. As I said, always that Friday after, you can crank holiday music until the end of Christmas or the end of the holiday season on the desk all day long.
All right, Andy, bring us home here with Thanksgiving dinner on that note.
What mine
do
is,
you have?
generally?
Yeah, what do you like? What do you have?
Since 1994, I've been cooking the same. I do the cooking. I've been cooking the same Thanksgiving meal, the one that Jeff hates, pretty much, for exactly the same way. I have 4 kids, and if I changed a tiny bit of the meal, they walk out. So it's going to be the same as it's been for coming on 30 years.
All right. Well, hopefully you can send over your secret recipe to Sherman, and we can see if we can turn them around here.
Yeah, I mean, look, it's tradition. I can stomach it for a day. It's all good. I get it. And, it is one of the most popular holidays here in the U.S. And it's one thing that we typically coalesce around. So, Andy, happy Thanksgiving. Thanks for joining us this week. I know this will push out a little bit after the fact because of our compliance, but we really appreciate you on the show today. Thanks for all of your insight, and just keep up the good work and put it out there for folks. So thanks again.